This is breaking news from Bloomberg.
All right, so we got about 10 data points to get to in this hour as they start to come in. Where we want to start to first, we'll go to the PCE price index. This is year over year. So for January, the expectation was for 2.5, came in right on target at 2.5. We go to core PCE price index year over year for January was 2.6%, came in right on target at 2.6%. I want to take you over to personal income for January. The survey expectation was for 0.4%, came in a tick higher, 0.9%. Personal spending for January. The survey was for 0.2%, came in down, off 0.2%. So that's a difference there. Want to see the markets and the reaction. Not much. We still have NASDAQ futures still teetering right now, up about 0.1%, 22 points. We have S&P futures up about 0.3%, 17 points. Dow futures up about 0.5%. We go over to the yield space. The 2-year yield, 4.48%. That's little change. And the yield on the 10-year, 4.25%. And that is little change. Tom.
Lisa, thanks so much. Turn to the market. All the inflation numbers pretty much on the survey, but I really want to focus out on real personal spending decline way off survey and personal income with a nice lift as well. I got retail inventories, which I don't understand. We're going to skip that. We're with Neil Dutta here. I got a little bit of an equity lift. I went right to the 10-year real yield. Came in a little bit, but it comes right back. Neil Dutta, am I right that this was a nothing burger?
I mean, real personal consumption fell quite a bit to start the quarter. That's probably going to put downward pressure on tracking estimates of first quarter GDP, and will probably prompt some marking to market of forecasts among the consensus. So I don't.
Right.
Is it a nothing burger? I mean, I think the inflation numbers came in line with expectations, but real GDP is probably getting worse. Not.
This is critical, folks, with real spending. I mean, what we see on the ECO screen of the Bloomberg, real personal spending came in light. Personal spending itself came in light. A little bit of a constructive revision. But, Neil, it's unfair to ask this, but it's unfair Friday. I mean, can you model out sub 2% GDP looking at 2 quarters of data to the 4th of July?
Yes, I think that's possible. I mean, look, most of the upside surprise in GDP growth last year was in 2 areas, consumption and government spending and investment. That's what drove most of the growth. So if you think those 2 areas are going to slow, it doesn't really take much. At the same time, you layer on the fact that residential construction is likely to get worse, not better. Export activity was a big driver for growth last year. I mean, if this trade stuff keeps up, I mean, there may be some risk to exports as well. So I don't think it's that much of a stretch. I mean, you're talking about a 0.5% monthly contraction in real consumer spending. I mean, these tracking estimates might be at 1% for the quarter after today.
Yeah, that's kind of where I wanted to go, Neil, because this amateur economist here, that's the number that kind of jumps out at me, and I'll just highlight it for the audience. Real personal spending, the consensus was for a decline of 0.1%, came in at a decline of 0.5%, so missed there. And you compare it to last period where it was revised higher to positive 0.5%. So a big delta there. I do know that, you economists tell me that the consumer is 70% of the economy. So that really does get your attention. Is that a number that moves around a lot?
Well, I mean, consumer spending tends to be, more stable. I mean, a lot of acyclical areas of consumption, right? I mean, so people have to go out and kind of spend. But ultimately, generally speaking, consumption follows income growth. And what you can basically say is that in January, I mean, there was an increase in precautionary saving. Maybe. I mean, that's basically what it is.
Right.
That income grows. But again, that goes totally against what people are sort of worried about right now, which is inflation expectations, right? I mean, that's allegedly the reason why the Fed is holding off. Everyone's pointing to you, Mish. Now, guys, think about what inflation expectations should mean. It should mean, number one, people are going to bid up their wages because we know that wage growth is set with short-run inflation expectations in mind. I mean, I don't know. Good luck to any worker that's going to try that right now. I mean, you're in for a rude awakening. But more importantly, it's you try to spend more to beat the higher prices later. There's no evidence that that's happening. You're seeing precautionary saving, not precautionary spending. So this notion that inflation expectations are rising and this is why the Fed needs to hold off.
Ian,
Sorry, don't buy it.
Neil, I want to get one more question in here. I think it's so important. Ian Lingon's being patient to wait for us. Neil Dutta, is there a wealth effect of the fancy people in the personal income, personal spending? Do you see the stock market? Do you see the way Paul Sweeney made money on NVIDIA? Is that in those statistics this morning?
Well, I mean, there was a great article from the Wall Street Journal about a week ago, I believe, about just talking about how consumption is being driven increasingly by the high end. And so, obviously it's affected by what's going on with asset prices. But what I know about asset prices is that, stocks are not making new highs. They haven't been. Number two, a lot of these sort of alternative assets like crypto have come under pressure. And more importantly for everyone else, home prices are moderating because inventories are jumping. So, to the extent that the wealth effect was an important driver of consumer spending, that's looking a little bit shaky now as well.
Neil, thank you so much. Neil Dutta with Renmac, just brilliant there as we looked at PCE and as Paul Sweeney mentioned, real consumer spending, real personal spending with a shock, a little bit negative, maybe new GDP markdowns. And we'll get to the bond market in a moment here with Ian Lingon. Our economic indicators, what we do each and every day, but particularly on these important key days. It's brought to you by IBKR with a year-over-year change in the U.S. business inflation. U.S. PPI, will it exceed 3% in February of 2025? At IBKR Forecast Trader, the yes was recently at 39%. What's your take? Trade your prediction at ibkr.com/forecast. We welcome all of you on YouTube nationwide. Again, go to YouTube, Bloomberg Podcast, subscribe there. Growing each and every day, 7 days a week, grows on a weekend.
Sure, yeah.
Is well. Joining us now, BMO Capital Markets, Ian Lingon. Ian, I'm looking at lower yields. Neil Dutt has given me lower GDP. Do we finally have in place the vaunted Lingon vector where we get shockingly lower trends in yield?
Well, I do think that we're overdue for a continued drift lower in rates. I wouldn't be very surprised to see the current move get 10-year yields a lot closer to 4%.
So
that gets your attention.
That gets your attention. So how do you think the Fed, Ian, is going to look at some of this data today as they try to get a gauge on their balance between the labor market and prices?
Well, I think that core PCE was in line with expectations. I think that to a large extent, the inflation profile is known. What's unknown is what's going on in Washington. How does that lead through to sentiment in the employment market? And that jobless claims figures from yesterday were a bit troubling. We're at 242. It's the highest since early December.
So again, that kind of suggests that it feels like the Federal Reserve's just like the rest of us. They're just kind of looking down to Washington, D.C., trying to stay on top of all the news flow coming out here. How long can they sit on the sidelines, do you think, Ian?
Well, I think that the Fed can avoid cutting rates again, at least through the first two quarters. I think it's very reasonable to assume that they skip the next few meetings. The first rate cut maybe comes in September, but there's a lot of uncertainty between now and then. The only way that things are going to shift dramatically is if we see a further correction in the equity market that tightens financial conditions or an increase in the unemployment rate, both of which are possible.
We're going to have to do an audible here. We're going to come back to interest rates with Ian Lingon. Ian, Canada just reported a whole series of economic data, and I'm sorry, it's positive, including, I think I see here, third quarter GDP was revised from a gloomy 1% up to 2.2% is well. You've got the Bank of Montreal Combine working for you. How do you filter in the response of Ontario, Quebec, Alberta? How do you, when you see their response to proposed tariffs from 1600 Pennsylvania Avenue, what does that do to America? What does that do to our GDP? And then on to your 4%, 4.0% 10-year yield.
Well, we do know that the Canadian economy is a lot more rate sensitive. And the Bank of Canada has been quite a bit more aggressive on the rate cutting side. So seeing the Canadian economy respond positively isn't that surprising. What I worry about, and I think that most Canadian banks do, is what happens with this looming 25% on the 4th of March. Does that really derail growth in Canada? The short answer would be it probably we probably see a material hit, which should translate through to lower rates. And the US probably gets a bit of a downdraft as well. So I think that there's a lot of cross currents brewing in favor of lower yields in the near term.
So what does Bank of Montreal say about Doug Ford of Ontario and what he's going to do in Windsor, Canada to put X tens of thousands of Americans out of work? How does Bank of Montreal see that sequence if we get it?
Well, I think that the short answer is we're all in the position where there are a lot of political uncertainties, and the back and forth between leaders, whether it's coming from Trump, whether it's coming out of China, whether it's coming from Canada or Mexico, will continue to fuel this uncertainty.
So how do you think this, I guess coming back to the U.S. here, we had the real personal spending came in materially weaker than expected there. How does the Fed look at that kind of data?
Well, I think the first thing the Fed would say is the consumer remains on strong footing. Take a look at the longer term trends, and there's no real reason to start worrying about the consumer yet. It's one data point.
Yep.
I'm looking at that and I'm saying, okay, this is not going in the right direction. If Q1 ends up with a 1% annualized growth rate, that will matter to the Fed, because that is the type of economic slowing in an environment where we might see higher inflation in the medium term or near to medium term. And that's a recipe for stagflation. And that's got to be a concern for the Fed.
On your commute across the nation, good morning to those of you in Canada waking up as well. From the Maritimes out to British Columbia, we say good morning. It's Bloomberg Surveillance with all of our digital efforts on radio, including Apple CarPlay, Android Audio, and the shock of Sirius, how well that's doing for us. Good morning on YouTube. Subscribe to Bloomberg Podcast, humbled by the audience today. Thank you so much for tuning in. Ian Lingen with us now of BMO Capital Markets.
Ian, we're looking at a 10-year U.S. Treasury right around, 4.25% right here. And I guess you could say it's still kind of within a range we've seen for a while here. But where do you think we end up the year on the U.S. 10-year Treasury?
Well, when the Fed is on hold, like we expect them to be for the next couple quarters, that tends to translate into a range of about 110 basis points for 10s. And so I think that by the end of this year, we'll be back towards the bottom of that range, which puts us at 4% 10-year yields. I think the bigger drama is going to play out in the 2-year sector, and we see 2-year yields at 350 by the end of the year.
I mean, this is where Michael Purvis was at Tallback, and I think he's scheduled next week. He's fly fishing somewhere.
Good for him.
Right now. But, to the point, the short-term paper, the Sweeney yield, I mean, did he just say 350? Is that what I heard?
No, only 4. We'll get down to
4.0. No, the 2-year yield.
Oh, the 2-year, yeah.
4.05
Sure.
right now.
Yep.
Equity markets churning here, up 18 right now. The VIX comes in a little bit, a better tape, 20.80 on the VIX, Paul.
Ian, a lot of folks out there, both academics and practitioners, say this Federal Reserve historically has used kind of not bad data, but certainly historically dated data, backward-looking data. And if you looked at the real-time stuff, you could make the call that inflation's already whipped, and maybe they should be even cutting rates here. How do you think about that?
I'm very open to the idea that it's difficult for monetary policymakers to use hard data because there is the lag in data collection, there's the lag in reporting. However, I don't think that the idea that if we look at the real-time data, for example, oil prices for some of the more obvious markets, that the Fed should be basing their monetary policy decisions off of that. Instead, it is those forward-looking indicators. So look at break-evens, look at the survey-based measures, and that's what the Fed is worried about. And I think that that's why the Fed's going to be reluctant to start cutting again.
So on a yield basis, if we get a Lingen 4.0, just, you're sitting around and having a Labatt's. I mean, Ian, just cut to the chase. What's it mean for the housing market? Is it like boom recovery, Or is the ambiguity that wages are slow, as Neil Dutta talked about, where we don't get a housing recovery?
I think that the housing market is going to struggle. Part of the reason is that the mortgage rate to treasury spread is still relatively wide for a variety of reasons. And as long as mortgages are high, then translating this through to a stronger housing market is going to be difficult, especially if we see an increase in the unemployment market or the unemployment rate. That's where I start to get really worried about housing.